Okay, well, good morning. Perhaps I can introduce myself. I'm Simon Pilcher. I run the fixed income business of M&G Investments. We're an asset manager, an investment manager, and in common with other investment managers from across Europe, we invest the assets of end investors, retail investors, pension investors, insurance investors. We act as their agent in the market. My firm does not act as principal. It's not licensed to act as principal. We only ever act as agent on behalf of our clients. And we have clients from right across Europe. This is a Europe-wide issue. So whether you're from Austria, Spain, France, Germany, Italy, or the UK, I think these issues are common. And as a company, we have money that we manage on behalf of millions of individuals, and as an industry, this is an issue that affects tens of millions and possibly as much as 100 million different investors from across Europe. We clearly invest a lot of money on behalf of people who are investing themselves in CCAVs or UCITS or OICs, open-ended investment companies. And so for us, accessing liquidity on their behalf is critical, because our daily inflows or outflows are regularly over 100 million euros a day, and we therefore need to be able to access that liquidity in the market in order to ensure that our funds remain open for fresh money to come in, to be invested, and perhaps more importantly, for clients to access their money when they want to liquidate their investment. I just want to say parenthetically at the beginning that despite us being one of the very largest investors in Europe, so I'm responsible for about 130 billion euro of fixed income assets, despite being one of the very largest, we do all of our fixed income trading through voice markets. We do nothing electronically. That's a very conscious strategy, and it's the only way we believe in which we can access the liquidity from the market by having a very relational interaction with the counterparties with whom we deal. It's a critical point that they know with whom they're trading and how we're going to trade, and that through them interacting with us, they can know that the information that effectively I've given them and they've given to me will remain private, such that they are in a position to trade out of the positions that they're taking on from me. When thinking about the challenges and issues that MiFID II comes up, we need to be very careful and thinking that there are a huge number of different savers that this can end up impacting. And it's critical that we think about the orderly functioning of the markets for all, and that this is not driven merely for a very small, select minority of end investors, that we're thinking about the impact on all savers. So whilst it's critical that we think about how individuals access bond markets as individuals in their own name and without the use of a market professional helping them, we also need to think about how they can access a wide range of investment products that genuinely meet their needs, and their needs as they age and as they save for their retirement. So when considering the strategic challenges presented by MiFID, my primary concern, and I might go so far as to say my primary fear, relates to liquidity. During the last crisis, 2008, 2009, there were quite a number of securities funds that had to close to business. Effectively, people, they were suspended from trading because access to liquidity was impaired, and effectively that became a self-feeding route on those funds. Clients could not access their money, and that was a very serious issue, I think, from a regulatory perspective, but also from the perspective of those hundreds of thousands of savers impacted. That was particularly an issue in the French market. Now, M&G held the position. We were able to continue accessing liquidity for our clients. That was of paramount interest for us, and that we did not shut any of our funds. But I want to ensure that in the future, we and others active in the market are able to ensure that our clients can access their money in almost all situations. And so what we need is appropriate and proportionate transparency that does not harm liquidity. I'm sure it's already been said, but I want to reiterate the fact that fixed income is not equity. There are hundreds of thousands of different individual securities within the fixed income markets in Europe. There are relatively few individual equities. And within the fixed income world, whilst an individual company may issue many different bonds, each of them is individual and different and traded separately. Whilst it might have common themes, each security is separate. And that's why I need to access liquidity from providers of liquidity who are willing to warehouse large positions that I or my rivals in the market may well need to pass on. It's critical that I can access that warehousing provider of liquidity. And that requires capital from market makers, and it requires both human and financial resources to be deployed by them. And clearly, ultimately, they need to make a return on that capital. Not too big a return, but they need to make a return. So if we think about transparency, post-trade transparency, I think is broadly speaking needed, is going to happen, but I want to ensure that it's proportionate to the needs. And from my perspective, that means ensuring that we have suppression of large volumes. But why does the individual need to know that a very large trade has gone through? Surely they need to know that a trade has gone through and that at the price at which it's been transacted. And we need to ensure that there are appropriate delays to ensure that those who've taken on to their books the risk associated with a large trade have time to trade out of that position without the market knowing that they are long a particular position and gunning for them. Pre-trade transparency, I think, is an area where we need to be exceptionally cautious. And I'm particularly concerned about some of the proposals in this area and the risk that it provides, in my judgment, to the willingness of people to make markets in securities. Because if people know where trades, large trades in particular, are about to take place, then I think we're likely to have significantly greater risks being borne by those making those markets. They themselves will devote less capital to the markets. Night follows day, there'll be smaller volumes transacted, there'll be wider bid-ask spreads so that they can recoup a decent return on their capital, with consequential damage to end investors. They will have to suffer larger bid-ask spreads. They will have clearly costs too to issuers, because if I know that I'm investing on my client's behalf in a less liquid security, I need to have a higher yield, a bigger coupon. That obviously has a real impact on the end economy, because corporate issuers in particular will find their access to capital is more expensive. And finally, clearly, lower volumes mean that there's a greater risk of many more funds having to shut, to withdrawals, to redemptions, with serious reputational and practical consequences. So I want to say that I think it's critical that we think carefully about possible solutions at this early stage. And so any pre-trade transparency requirements need to have the efficiency of the markets as very much to the fore. And whilst in the area of equities, I think we've shown that we can have efficient markets operating, given the very significant differences between fixed income and equity, and in particular corporate bonds, I want to express my concerns and reservations. I think there are ways in which pre-trade transparency could be tailored. It may well be, for instance, that pre-trade transparency is appropriate and reasonable for government bonds. Indeed, for corporate bonds, perhaps in their first 3 months after their issuance. Typically, there is a life cycle to a corporate bond. When it is first issued, it's reasonably actively traded, but very rapidly, most corporate bonds become rarely, if ever, traded, and the meaningfulness of pre-trade transparency I would seriously questioning. So the bottom line is that we need to ensure that any pre-trade transparency intervention is measured and balanced and tailored to the market realities. Now, the challenge here is clearly that markets themselves can change very rapidly. We've seen in recent quarters that even government bond markets themselves selectively can become woefully illiquid, and there's a measure of pre-trade transparency that I think that can damage the functioning of some of those markets. Clearly, market crises themselves come on very quickly, and in that environment we need to be ensuring we're encouraging liquidity rather than hindering it. So a one-size-fits-all approach, I think, would be extremely damaging. I'd like to just offer a few thoughts then in some other areas. First, I'd like to say that from a reporting regime, my plea would be that it's implemented in such a way that it's as efficient and cost-effective as possible, that we avoid duplication, that there's a requirement perhaps on market makers and on organised trading facilities, etc., to report, but that is not duplicated from end investors. If end investors are required also to report all trades, given the number of end investors, that could be an incredibly expensive obligation that's imposed on the market. And finally, just a few words, if I may, on the area of what constitutes best execution. There's been a suggestion that price only is the thing that people should focus on. I would want to resist that very firmly. I think it's a very complex judgment as to what constitutes best execution. But for me, critical in my assessment of with whom I'm going to trade are factors such as how quickly I'll get the trade done, the volume that I can get transacted, and in a world when banks are going bust not infrequently, I don't want to be forced to trade with Lehman or MF Global in the days or hours before they go bust because they're, quotes, offering me the best price. I think that would be crazy. So in summary, I want to conclude by saying I hope I've convinced you that pre-trade transparency in particular needs to be treated exceedingly carefully, that post-trade transparency needs to be proportionate, and we must ensure that liquidity in the fixed income markets is of paramount importance, and therefore the burden of proof must be very strong before significant changes are brought into being, because we risk destroying a market that is essentially functioning for almost all investors extremely well today. Thanks very much.